Any reporting methodology requires some base concepts, some core beliefs to build on. This resource will consider those fundamental concepts for accounting. These concepts are so ingrained in the minds of economists and accountants that they may be taken for granted, but we will discuss each of these concepts and assumptions in turn. When appropriate, we will consider examples to clarify the concept. The first fundamental concept for accounting is the separate entity concept. What exactly is an entity? In accounting, an entity is an organizational unit for which accounting records are kept. This will usually be the company of interest. The separate entity concept implies that the entity is distinguished from its owners. Therefore, we must separate the actions of the entity from those of the individual owners. The next concept is an assumption that transactions are performed at arm's length. In accounting, transaction is a broad term for anything related to the economic health of an entity. Any exchange of economic resources like cash or other assets are clearly transactions. But any action or condition that has economic impact on an entity is also a transaction. Examples of transactions include the obvious, like borrowing money from a bank or receiving funds for selling a product, but also less obvious things, like the depreciation of the worth of a company vehicle. So what is the assumption of arm's length transactions? First, it implies that both parties in a transaction, the buyer and seller, are both rational and that they are free to act independently. Furthermore, both parties want the best deal possible. Think about selling a used car. The owner wants to receive a good price, while the buyer wants to get a good vehicle for a reasonable price. This leads to negotiations until they reach a price agreeable to both owner and buyer. To ensure consistency and objectiveness, all transactions are listed at their historical cost, which is the original amount of the transaction. This cost is the market value at the time, or the cost prevalent at the time of the transaction. Since the transaction occurred at arm's length, this is assumed to be a fair and accurate description of the cost at the time. Of course, the value of the item purchased may change over time, so the value may be adjusted with appropriate gains or losses. As mentioned previously, all accounting information is presented in terms of money. In the United States, these transactions are identified in terms of dollars. However, not all economic activities can be measured in monetary terms. These items would not be included in the accounting model. For example, employee morale is very important to the economic health of a company. Happy workers are productive and effective workers. However, it is impossible to directly measure morale in dollar terms. Therefore, it is not included in the accounting records of a company, although some indicators, like employee wages and production levels, would be included. The final assumption made in accounting is the going concern assumption. This is the assumption that a company that currently does business will continue to do so for the foreseeable future. Why would this be important? Think of a store like Circuit City, which was an electronics and home theater supplier that declared bankruptcy in 2008, although it is rumored to be returning. What happened to the company once it declared bankruptcy? Specifically, what happened to its inventory? Prices dropped. The company held going out of business sales in an attempt to capture any value from their stock of inventory. This would make for very difficult accounting, because the historical cost of those goods would no longer be a reasonable estimate for the inventory of the company. The assumption of going concern simplifies this process and allows the accounting to provide a realistic view of the company's standing.